Good morning, ladies and gentlemen. Welcome to WAM Vault Live. It's exciting to be here in person again and see you all and a number of familiar faces. I'd just like to give a disclaimer, from a legal perspective. Our views of the market and specific companies are dynamic, and it's written here and can change daily and can change probably minute by minute. And we're able only to provide general advice, not specific advice. In terms of opening today, I'd like to acknowledge the Gadigal people of the Eora Nation, the traditional owners of this land, and pay my respects to elders both past, present and future. I'm Jeff Wilson, I'm Chairman of Wilson Asset Management, and I welcome you all that are here in person and that are here virtually. As you know, we're going to have an action-packed day. It's been a couple of years since we've been able to press the flesh, and that's been, it's been a tough period for us all, but it is great being here in person. You know that it's your company. We're only here because of you. We love what we're doing, very passionate about what we're doing. And you're going to see, we thought in terms of structuring it, with our first one back, we'd try to have it a bit more interactive. Rather than us having the slides and presenting to you, have it more as a question and answer. So we can catch up on those lost couple of years. In terms of the team here, like at Wilson Asset Management, we've really got a good sized team these days, 54 people. We're based, obviously, we're based in Sydney. And on the investment side, a lot of people think I do all the work. I do very little of the work. Someone told me a long time ago, it's all about making sure you employ people smarter than yourself. So that's what I've tried to focus on. And you'll be hearing from some of them today. And we've got 15 investment professionals that are managing all our money for us. And they're very passionate about what they do. So we'll have the Q&A session with the Wilson Asset Management, the lead portfolio managers. Then after that, we'll have future generation panel and question and answer session. And then for anyone who wants to stay for the more formal part of the future generation entities, we've got the FGX AGM and the FGG AGM. And you would have seen, there was a bit of press this morning that we're in the process of getting a new chair of FGX, Mike Baird. We're very excited about that. So the future generation entities will be a little bit later. In terms of the market, we've had, what is going to happen with the market? Obviously, if I knew the answer to that question, I probably wouldn't be, if we all knew the answer to that question, we wouldn't be here. Because but in terms of what I've experienced, and looking at the market, we've had a period of 20 years of interest rates coming down. We're now going through, in the last sort of 5 or so years, very accommodative monetary policy. We're now in a different phase. We've got inflation and interest rates going up. And to me, it's going to be a more difficult period. And in terms of, I know this, we've already done some presentations. Some of them, they said, geez, Jeff, you sounded pretty bearish. And I suppose I've got the scars of '87. I've got the scars of the GFC. So I like to be plan for the worst and hope for the best. In terms of one of the fortunate things is in our team, Katrina, who runs WAM Global, she's was telling us about a great book she's reading at the moment. It's called Richer, Wiser, Happier. how the world's greatest investors win in markets and life, by William Green. And I thought, what a great title. But in there it talks about, you talk about being bearish, about worried about the market. It talks about a 20-year, the 20-year period before this book was written was the 20 years to 2017. And over that time, the US market went up by 7.2%. Now, if over that period you missed the 20 best performing days, so that's 20 days over 2 decades, and you weren't in the market for those 20 days, your performance would be 1.1%. So I suppose what I've learned over time is if you have, you're invested in a good structure, you've got, and we think the LIC structure is a great structure, you have professionals managing your money, and I suppose it comes back to the old saying, it's time in the market rather than timing of the market. So when I feel bearish, I try to think to myself, well, I've just got to, we've got to stay in the market. In terms of the team that's coming up today, I'd actually now like to welcome them up to the stage. Where are the guys? Actually, it's a long way to walk from the back of the room to the front of the room. So they'll be sitting in order. Matt Halpt, who is the lead portfolio manager for WAM Leaders. Then we've got Katrina Byrne, who is over. Katrina is living in New York these days, managing the global fund. She flew back out the other week. And Oscar Oberg, who manages WAM Capital, lead portfolio, WAM Capital, WAM Microcap, WAM Research, WAM Active, and that's it. So look, thank you guys. And the initial part, I'll just ask some questions and then we'll open it up for the general floor for any Q&A. Obviously, in the current market environment, everyone's trying to grapple with what's happening in the world and what is going to happen. Matt, do you want to just talk a little bit about that and what you're seeing and how you're positioning the portfolio? Or maybe what you're seeing and then we'll go back to the portfolio a little later.
As you said, try and time the market. Incredibly tough, but here we go, we'll try and time the market. So I reckon the best way to look at the market is where did we come from? And we just came from the most extreme period of policy ever. And with extreme periods, you get extreme valuations. So that's your starting point. But I think that the most important thing is to look, where were we pre-COVID? So pre-COVID, from 2016, the Fed were in a hiking cycle. Now they kept hiking, very much like what's happening now. 2018, they put through 4 rate hikes. December 2018, Powell did the big backflip where he was like, okay, we've gone too far on rates, we're going to pause now. And then mid-2019, they actually started cutting rates. So this is a very good proxy for what's going to happen this year and next year. They went too far, the market started imploding, the equity market and credit markets were slightly dysfunctional, and there was a lot of pressure. So when you look at that, it's a very good indicator of what's going to happen this year and next year. We were actually heading into a recession in 2019, 2020 before COVID hit. And also the most important thing to think about pre-COVID was supply chains were already disrupted. We had the tariff wars, we had China, US, it spread over globally into Europe, everywhere. So you had tariffs in place and supply chains were already fragile. Then you had this COVID hit, which just blew supply chains apart even further. So the economy we came from, you have to ignore COVID period because it's just abnormal policy. But we were coming from a fragile economic place pre-COVID, and now we're coming out of that through the distortion of policy into a fragile economy again, and we're seeing that now as economies are slowing down. So the sell-off in equities we've seen now has been a function of interest rates going higher as the market prices in interest rates, stocks go lower. That's phase one. Phase two is an earnings slowdown, which we're starting to see now, which is demand destruction through inflation. That is happening now. Phase 2 will be the economic slowdown or the earnings slowdown, which will happen over the remainder of this year. So it is going to get worse before it gets better. But the great thing about markets are forward-looking. So we can see this right now. Everything we're looking at, probably the end of this year, can start to get a lot of optimism around the scenario we'll be facing. The Fed would have hiked. They would have paused. They're already starting to put that in the market now around pausing. So everything is working out how we think it will work out, and we should get a pause in policy rates and then a reduction in rates. But in the interim, the economy is going to slow, the Fed are hiking, and central banks are hiking into a slowdown, which is a terrible recipe for risk assets. So that's where we sit at the moment. Will they pivot? Well, the whole goal of a central bank is inflation. Inflation is their goal, their mandate with employment. So they will keep hiking into a slowing economy, which is it's a collision course for risky assets. So things are pretty dire at the moment, but things will get better. We've been through these cycles before. We know how they play out. They play out when economic conditions bottom or you get a pivot in interest rate environment. So those are the two things we're watching at the moment. So it's probably later this year, but of course it can change very quickly, but that's how we see the world at the moment.
Thanks, Matt. And Katrina, so you're based in New York. Bird's eye view of what's happening in the world. Like, what are you seeing, or what's your view? Or
yeah, absolutely. And would completely agree and echo what Matt said. I think it's been interesting. You had the fragility of supply chains, etc. You had the COVID pandemic, which put extra pressure. Now you've had Ukraine crisis, which is obviously putting pressure on food and energy prices. And then you've got zero COVID policies in China, which are putting additional pressure on supply chains. So it is a bit, it's very messy at the moment. And that other point around interest rates is also, we've had, as Jeff talked about at the start, this ongoing period of lowering of rates, and that's really led to enormous divergence between what sectors have worked and which haven't. And this era of free money has led to enormous escalation in asset prices, whether it's in equities, whether it's in house prices, crypto, NFT, any asset has seen this, enormous run up. And so, what we're seeing in terms of interest rates going up, I think is actually really healthy for asset prices that are totally inflated on the basis of not much. And I think I'm actually very positive in terms of we are seeing a reset in some of these insane valuations that we've seen. When we look at a lot of the tech stocks in the last few years, it's been very difficult when you actually have an anchor to earnings, because a lot of these tech stocks have gone up to insane valuations on the back of no earnings or very little earnings. And so we think it's actually really healthy. As rates go up, we're actually going back to focusing on companies' earnings and reasonable valuations of those earnings. And so I'm actually really excited about the period ahead. None of us like seeing markets go down, and that is, painful for all of us. But I think in terms of the opportunities that we're going to see, over the next 6 to 12 months compared to the last 5 years, it's going to be actually really exciting. And you're seeing that. And, in terms of those, overnight, this week, say Snap, which is a US tech company, it fell by 43% and it's still on 250 times earnings. It's just crazy. And so there's no bottom to as in it can fall, it can halve again and halve again. And you'll still think, I still can't justify the valuation. So I think some of that, hot air is coming out. And I'm actually really excited, and I think that's healthy. Markets go in cycles. None of us like seeing share prices, our portfolios go down. But I think, it will. The opportunities that are going to come up in the next, 6 to 12 months are actually really, really exciting. Particularly, like Oscar and I tend to love investing in small mid-cap companies, and what we've seen of late is, as we go into any risk around, the economic cycle, etc., they tend to get hit aggressively first. And so we have seen that. In US stocks, for example, it's the biggest divergence between small and mid-cap stocks versus large in 37 years. Haven't been at this level since the dot-com bust. So, we've seen a lot of share prices already hit very aggressively. As Matt said, we've had the valuation piece where we're resetting on that first. Next is earnings. But we're already seeing valuations of certain companies that we're looking at look really exciting. So not fun as we watch share prices go down, but really quite optimistic about, as we get through this period, a return to sanity.
So quickly on those numbers, so Snap's got to fall 96% to be on a PE of 10.
Yeah.
So Oscar, obviously, looking at the Australian mids and smalls, very bottom up, in terms of spending a lot of time with companies and management in Australia. What are you seeing? What are they saying? And how are you seeing things?
Yeah, I mean, it's interesting. Most companies are pretty positive when we speak to them across a range of sectors. So a lot of them are puzzled as to why their share prices are underperforming. I think the interesting thing as well is that balance sheets of the companies that we look at are probably the best they've looked for some time. Much stronger than they were going to the GFC. Also, much stronger than they were going before going into COVID. But like as Katrina said, it has been a challenging time for the small cap companies that we focus in on WAM Microcap and WAM Capital. I think for us, the positive is that over the last 20 years, we've seen cycles like this before, managing WAM Capital. And I guess every time, you trust your investment process, and every time we've been able to come out and bounce back and be in a stronger position than we were when it started. So we're feeling very good about the environment, as Katrina said, going forward. Valuations in some sectors are at multi-decade lows. Balance sheets are strong, and I guess most importantly, there's plenty of catalysts out there, and we think that can drive share prices over the medium to long term.
Yeah, it is strange. I know as investors, we tend to get really excited when the market falls. Well, because things are getting cheaper and you can find real value. In terms, just with you, Oscar, in terms of the investment process, just want to talk about that. Obviously, a lot of company contact. Do you just want to take us through, the investment process?
Yeah, sure. And across all of us, we see thousands of companies every year. And I'd hate to know what the number is to be fair, but in terms of the process, it's consistent across all the funds. We're looking for strong earnings growth, and then we qualitatively assess management and the quality of that company within its chosen sector. But above all, we need a catalyst, and a catalyst is something that changes the perception of the market of that particular company, such as an earnings upgrade, an acquisition, a divestment, something that can drive the share price going forward. I think, Jeff, one of the interesting things right now, particularly in our space, and Katrina would probably say the same thing, is very rare that the catalysts don't work, but it has been like that really since around September, October last year, and that's just a function of the volatility that we're seeing in the market, and that can impact small caps. I'll give you an example. On Monday, we own shares in Elders, which is an agricultural business, in WAM Capital. It upgraded by about 30%. And we're like, oh, okay, that's good. The share price might be up a little bit. I think as of yesterday, it was down, lower than what it was before that result announcement. So that sort of shows you the headwinds that we've been under. It will change. And as I said, we're seeing a lot of opportunities and great valuations.
And it gives you, in terms of that, the response, the stock it gives you an idea of how the market's feeling, isn't it? In theory, there's net selling, and it doesn't matter. You can exceed expectations, but because the market mood is negative. And I remember, when I started in the early 1980s, I remember I was taught then, I'm not sure what it is these days. I'm sure it's more scientific, but it was half the performance of the stock was the overall market, and the other half of the performance of the stock were the fundamentals of the stock. I'm sure there's a lot more scientific way of getting to that same conclusion. Matt, do you just want to talk about in terms of, because you're looking at the top 200 companies in Australia, and really picking the eyes out of those. And I know, 3 years ago when WAM Leaders, when you outperformed by 10%, I thought, well done, Matt and Johnny and the team. exceptional result in a very competitive, when you're just looking at those companies. And then when last year you outperformed by 10%, I thought, geez, well done. And then this year, I think you're outperforming by 15% at the moment. And that's just looking at the top 200, which to me is, congratulations, exceptional work. So how are you positioning the portfolio at the moment?
Yeah, at the moment, as Jeff said, I guess the differentiating factor is we run much more of a global macro overlay on the portfolio, because as Jeff talked about with the sensitivity of our companies is more global growth related or domestic growth related, like not stock specific. So we're watching every market in the world, every asset class, trying to get clues on how to shape the portfolio. So I guess this year we were positioned for rate hikes before they played out. How we're positioning now is quite defensive still. So we had a bit of a tilt towards staples, healthcare, and again, we've done the back testing on these environments. What we do is we sort of back test the sensitivities of stocks against previous cycles all the time to get a bit of a hit list on how to position, some clues, and then just work it out. So we had a bit of a defensive tilt. How we're positioned right now, we're still overweight some of the mining companies, like more China specific, not global growth related, which is copper, but more of the iron ore exposed companies. It's still very much defensive tilt because healthcare companies generally aren't very cyclical because you've got a health problem, you need to get fixed. It's that simple. It's not really that discretionary except for the elective surgery type. So healthcare is very defensive, will work well, and staples as well. So we're quite heavy in Woolworths and Coles still, especially after the sell-off after Walmart, when, again, this is a sign of what our job is to read markets. So when we see Walmart miss earnings and get thumped in the US and then Woolworths is down 6%, that is a signal that we're starting to get the extreme negative positioning, because in market cycles you get extreme at the other side too, where you get a non-related event which will send a big company down 6%. That is a signal to me we're starting to get some silliness back in the market on the negative side. So that was the first instance. So it's going to go on for a bit longer, but you're starting to see that now. So defensive position. Our cash weighting is around 3%. We run a fairly low cash weighting because we try to position the portfolio with stocks rather than cash. So very defensive position, but really looking for that next inflection, which I think will be when interest rates are put on hold, which I think is coming. You're starting to get some clues now. Bostic, a Fed member, said that. Powell said it in the minutes around September, holding fire. So there will be another inflection point which we can position for, and then we've already got the playbook. If that happens, we've already done the work to work out where to go. So it's a bit of a holding pattern at the moment, but looking for that next inflection point.
Great, and thanks, Matt. And Katrina, obviously you're very much bottom up, meeting the companies, and what are you, in terms of, is there any particular companies you like? I know when the shareholders, maybe we'll go through that. A lot of the shareholders, when we're talking to them, what's your view of the market, and what's some stocks you're interested in? Anything particular?
Yeah, sure. As you said, what we're doing is constantly meeting companies, and it's interesting. I mean, it's depending on the sector. It's obviously there's a lot of things that are tough in the operating environment. And so you're trying to find businesses that can still do well with a lot of headwinds in terms of whether it's labour inflation, energy inflation, input costs across the board going up, supply chain disruption. And so it's a matter of trying to find businesses that we think can still do well in this operating environment. And so, that kind of leads us down the path of, often at the moment it's finding, making sure that you're in businesses that have pricing power, so that, if your labour costs are going up, you're able to push it on, to the end customer. And so that often leads you, to businesses that have market-leading positions in whatever their sector is, or where the input cost component, say, of labour is actually really low. And so businesses that kind of fit in that, realm would be, for example, we own Exchange, so the Deutsche Börse is the owner of the Frankfurt Stock Exchange. They also own Eurex, which is one of the world's largest derivatives exchanges. And so exchanges like the ASX in Australia, they're great examples of businesses where you have a high fixed cost in terms of infrastructure, investment in your technology, etc. But then once you cover that fixed cost, incremental trades and volume that go on that fixed cost come in at very high margins. And so, say Deutsche Börse, for example, at the moment, I mean, the best thing for them is that markets are getting more volatile because they're clipping the ticket on all that volume. So that's an example of, I think, a business that has both structural drivers in that volumes of fixed income, volumes of derivatives are coming from off-market to on-exchange, so there's a structural element, and there's also this cyclical uptick that's happening in terms of more volatility coming into fixed income markets as rates go up, and so they're actually a beneficiary of the current operating environment. So businesses like that, firstly, great market position, fixed ability to price well, and actually a beneficiary of volatility that is actually, most businesses are struggling in this operating environment. They're actually benefiting. So that'd be an example of a business that we like. I mean, thematically, we've got a lot of positions in the portfolio that are geared into some of those trends like health and wellness, where we think, there's only going to be increasing spend on health and well-being post the pandemic. So we tend to like to own the picks and shovels rather than, we don't take any bets on biotech trials, etc. So businesses like Avantor and Thermo Fisher Scientific that make medical equipment that sell to every pharmaceutical and every player in the healthcare industry. So we think they're well positioned. I mean, businesses geared into automation like Zebra Technologies, Concentrix, we own because labour is a massive issue the world over, and we think businesses generally are trying to do what they can to take out the pressure they're feeling from labour costs. We've got businesses that kind of gear into all those thematics that we think can do really well in this operating environment.
Thanks, Katrina. And Oscar, any stocks for the investment bag, show bag?
Yeah, we've got plenty. I'm sure there'll be a lot of questions, maybe some sort of buy, hold, sell or something like that probably a bit later. But company we quite like at the moment is Mars Group. It's one of our largest positions in the portfolio. The ticker there is MGH. Business listed at the back end of 2020. It's a founder-led business. Over 60% of the shares on issue are owned by board and management and the founders, which is always a good sign. In terms of what the business does, it's a building materials and construction business, but it's located in regional Australia. And I guess one of the key themes that we've seen over the last few years is due to expensive cost of living in the cities, in particular Sydney. We've seen a whole exodus of people go into regional areas such as Dubbo, Tamworth, Orange, and so forth. And I can't help myself in these things. I am a country boy. And those towns, in terms of population, have really exploded over the last few years. And so Mars is the dominant player there. And if we have a look at sort of what the run rate of earnings for this business in the second half of this financial year is, we think that alone can drive a 10 to 15% earnings upgrade into the August result. Has a very strong balance sheet. It's got a lot of property on the balance sheet. And we think the stock can double over the next 2 or 3 years.
And I'm just going to throw this one in, stock without notice, only because we were talking about it yesterday. And I know a number of people here would be aware of the company, and I know at our various presentations I've made various comments and got in trouble for those comments. AMP, what are your thoughts on AMP?
Yeah, it was funny. I was talking to a gentleman outside, and I saw his expression on his face when I mentioned it. He was like, "Oh, what are you doing?" Yeah, no, but we like it. The big catalyst for us, it sits on the market-driven part of the portfolio, was the sale of AMP Capital, or Collimate Capital as they were referring to. That has been completed. And if you have a look at the net tangible assets of the business, it's around $1.35 a share, and that's what we think is probably the worst case. It's actually higher than that if they achieve various performance hurdles. Current share price is about $1.09, so it's trading at a 20% discount to its NTA, which is fantastic. But what's more important is that due to the sale of AMP Capital, they're going to return probably about 50%. Or they're going to return all that money to shareholders, which will equate to around 50% of the current valuation of the company.
So the discount becomes bigger.
Yeah, and there's more asset sales to come. So no, we like that. It's one of our largest.
And Matt, what are any particular stocks in the top 200 you like?
I was going to do one because everyone loves banks, so I thought I'd talk about National Australia Bank, and it's a bit of a joke within my family because my mum bought me some NAB, I think it was back in 1998, and I think it was $30 when she bought them, and I think they've been under $30 for like 30 years, so I always remind her of that. But so National Australia Bank, you know, we all know the company, but they really haven't had an effective CEO or chair or board for that period of time too.
Isn't it incredible? Yeah, I know there's a bit of age here, but back then they were the bank, weren't they?
100%, yeah.
Yeah,
And
just the most efficient and...
Correct.
Yeah.
And they go in very long cycles. So obviously Westpac had their issues in 91, I think it was.
Yeah, when they nearly went under.
Commercial lending and they still haven't recovered. Westpac haven't recovered since St George. But yeah, so National Australia Bank, they finally got a great CEO. So Ross McEwen, he's fantastic. When we meet with him, he's just, you know, back to basics. I'm going to get the figure here wrong, but he went to all his staff and he was like, do you know we spend $700,000 a year on internal coffees? And every time you take one of your employees down there, that's shareholder money. Like, this has to stop. Like, all these little things, like just getting some discipline back into the business.
Geez, I bet, Kate, can you check how much we're spending on internal coffees?
But essentially,
what else do you do?
like, there's another example of changing your password for internal. If you're an internal NAB person, you want to change your password. They had outsourced it, so you have to call IBM or whoever was running it, and you get charged for that, for changing your password, like a consulting fee. Like, so bring all the IT back in-house, back to basics, you know, focus on the customer, get rid of all the legacy loan products where there'd be like hundreds of loan products which were not profitable, streamline it, straight through processing, the bank has got some momentum back. So clear outperformer in the space with CBA at the moment. So I think NAB looks good, cycle aside.
Yeah, okay. Yeah. Thanks, Matt. And also, like we always, you all always hear us, talking about what we've done well and, et cetera, et cetera. What about the other side? Why don't you hit us with a stock that's disappointed in the last 12 months or last period, and sort of what you've learnt from that? Which way do you want to go?
I can go first. I've got one that's lasted for 3 years, IAG. It's so cheap, but it can't catch a break. Like, they had the fires before COVID, then they had COVID, which, again, this gets back to discipline. They were writing policies which were using the wrong wording from the Quarantine Act, so they weren't actually exempt from COVID. Like, what a mistake! $1.2 billion of potential BI claims, which it won't be, but
it wouldn't, like NAB worrying about the coffees. Don't worry about the coffees.
Yeah.
Worry about the wording.
Exactly, like just an oversight of having the wrong wording in policy. It's cost them a lot. And then we went into floods this year, so the business looks incredibly cheap, well capitalised. The management are good, turning around, but they've just been struck with 3 years of bad events. So it's been dead capital in our portfolio, for 3 years now. But we've still got hope. Barring another catastrophic event this year, if they get through to June, they should be right. But I watch the weather every day. Every time it's raining in Sydney, I'm like, oh no more floods, please. So we should be all right this year.
Yeah. So it's cheap.
It's cheap. Yeah. Well positioned, but will take a little bit of time to come out.
Okay. And Katrina?
Sure. Yes. So one that's been disappointing of late is HCA Healthcare. So they're the largest private hospitals operator in the US. So the equivalent of Ramsay Healthcare here. And so if I think about, why we liked the stock in terms of our investment process, it's got a fantastic management team. As I said, they're the leading private hospital operator in the US, so industry position very good. They've been very good, like Ramsay's done, of driving their acuity up over time, reinvesting in the business, and so earnings growth has been very, very solid. And then, on valuation, it certainly, stacked up. Of late, and actually through COVID, they did a phenomenal job. So the pandemic hit, they cut costs, they managed through COVID in 2020 and 2021 exceptionally well. But what's hurt them of late is, we all know it, the labour cost issues have certainly been there, but they'd been managing it very well. But what happened in the fourth quarter of last year was that because of Omicron being, so prevalent across the US, they couldn't, in terms of that labour force, the amount of people that got taken out during fourth quarter and the first quarter was huge. So their nurses couldn't, they didn't have the labour force, so they had to use a lot of contract nursing staff, which are a lot more expensive. And so their earnings got hit in the last quarter because of rising labour costs. The other issue, with nursing, and we see this across labour forces globally. Anyone that's been, and nurses are obviously in the line of fire in terms of the pandemic. So there has been an issue in terms of the nursing staff. Doctors are just exhausted. They've been dealing with years and waves of COVID, and so there has been a certain amount of the nursing pool that has left the industry. So it's partly a short-term issue in terms of the people that were taken out by the last wave of Omicron are coming back, but there is a bit of a structural, gap in terms of a part of the nursing pool that's been taken out of the workforce. The great thing about HCA is that 10 plus years ago, like they're the industry leader, 10 plus years ago they started investing in their own nursing schools. So if anyone in the industry is going to be able to replace their nursing workforce, it's them. But there's a bit of a hole at the moment in terms of where just their cost base is elevated. And so it's been disappointing, in the last quarter, their results. But the stock trades, so to put it in context, where I said that Snap is still trading on 250 times price to earnings ratio after a 43% fall, this stock's trading on an 11 times price to earnings ratio. So the valuation, has reset, and we think these issues are temporary, but it's been a disappointing stock in recent times.
And Oscar, what have you got?
Yeah,
we've only got a short period of time. No.
Thanks, Jeff.
You usually crack that one.
Yeah, that's true. Has been a while though, hasn't it? Well, I think I was sitting here when we were the last presentation. Actually, I was probably saying, City Chic has been a success story, and it's funny how things can change in the market. But yeah, that's been a tough one for us over the last 12 months. So this business is a retailer in the plus size women's category. It really was a success story for the team because we bought shares, I think around 20 cents in mid-2017 in the microcap fund, and we rode it all the way up to around $6.50 back in November of last year. And I think at that time, there was concerns around the consumer and a pending recession given interest rates going up, but probably the main thing was there was a little bit of uncertainty around one of their acquisitions that they'd made in the United Kingdom. And we sold a little bit at that point, but we hung on in a decent sized position. And our thesis was, the business has consistently upgraded earnings over its history since we've owned the business, and we thought it was going to upgrade earnings again. The interesting thing was that catalyst actually did play out. They actually upgraded earnings at the February result, but like a lot of retailers, their inventory rose quite significantly because of the China supply chain issues, and that spooked the market. The share price fell around 30 to 40%. It was interesting, the point you were making around the market versus earnings. Well, earnings for City Chic haven't changed that much, but I think it's probably down about 60 or 70% in the last 4 or 5 months. So that just shows you sort of what we've been seeing in small caps. But the lesson there, Jeff, was probably, when we had the negative feedback, we probably should have sold a little bit more than what we did.
Gotcha. So look, thank you guys.
Thanks.
Thank you very much. And I'd like to welcome Dania to the stage. Dania is the portfolio manager for WAM Alternate Assets. And thanks, Dania. Let's sit down. And the reason I mentioned a little earlier that specifically, I wanted to have the conversation with Dania rather than having her in the panel, is Dania joined us a little over 2 years ago to run the alternative asset our strategy. It's as a very wise shareholder pointed out, that it's an interesting group of assets, and from my perspective, I always like buying $1 for 80 cents. In WMA's case, I'm buying $1 for what are probably 87 cents. So it's still, at least I'm buying $1 cheaply. It's from our perspective, as in Wilson Asset Management, we think it's one of the, well, in terms of value, one of the most interesting ones we've got. One of our LICs. So we just wanted to have a bit of a conversation, an in-conversation with Dania. We won't have Q&A with Dania, but Dania, after we finish this, will be outside. So any specific questions you have, please do that. Now, Dania, like we've just had the equity guys. Obviously the market's been jumping around everywhere. You've come in and you've been managing the alternate asset portfolio for the last just under a couple of years. Do you just want to give people a flavour of when they buy? I know one of your great phrases is it's, what is it, democratising
alternative investing.
Yes, democratising alternative investing, and I know. I mean, the reason why I was very interested to get hold of this portfolio, it was probably a bit of a selfish thing, is over the last 10, 20 years, you've tended to focus, you tended to see all the very wealthy, smart people have exposure to alternate assets. I personally had virtually no exposure to alternative assets, and WMA is the only listed investment company that can get exposure to alternate assets. So do you just want to give us a little bit of a feel on what we're investing in when we buy a share?
Yes, thank you, Jeff. So WMA is a unique proposition, but as you said rightly, it's actually the only listed investment company on ASX now that offers exposure to retail investors to a diversified portfolio of alternative assets. So you'd see there are some offerings in private equity or private debt. Within our portfolio, we have investments in real estate, infrastructure, private equity, real assets that includes water rights and agriculture. And the mandate is quite broad, so there are opportunities to expand further into private debt and other asset classes. So it is unique because retail investors historically haven't been able to access those asset classes. In order to invest in unlisted infrastructure or private equity, you'd usually need at least 10, 15 million for just one investment. Plus, many investors couldn't really take illiquidity. We're talking about investments, some of them, they would be 5, 7, 10 years in terms of their duration. So the portfolio has a really good mix. We have about 26 underlying investments within the portfolio. It's well diversified. It's a live portfolio, which means the investments that are maturing, they're being exited, and they're being reinvested. But what is also really important about alternatives, I'm sure often when you see this word alternatives, you might think these are high-risk assets. The reality is within that opportunity set, there are investments with various risk-return characteristics. So we have exposure to investments that are predominantly income-yielding investments, very mature, low-risk investments. We have exposure to asset class like private equity that are predominantly delivering capital growth, and they are considered more of a capital appreciation investment. So it's a variety of the risk-return profile as well.
Gotcha. And in terms of your investment process, can you take us through that a little bit?
Yeah, so the universe is broad. Each asset class is very specific. So rather than starting with the bottom up and looking at individual investments, for me, the first step is really about understanding the macroeconomic environment, because also these are long-term investments. So very important to have a strong conviction in macroeconomic trends or themes when making those investment decisions. So within the portfolio, I'm focusing on 4 mega trends. Basically, these are macroeconomic trends with strong long-term tailwinds. And this one is increasing or growing aging population, which results in really interesting opportunities within healthcare, digitalization or technical advances, plenty of opportunities there, and lots of those trends accelerated post the pandemic, increasing demand for food, and finally, the very important one, the climate change, that again, from both opportunity set and risk management is a really important trend for me. But to give you a bit of a flavor, so you heard Matt saying they turn sometimes their portfolio 4 times a year. Within WMA, per year, I can make 4 to 5, maximum 6 investments per year. So a lot of work is being done at the initial stage before investing, including visiting assets, meeting the investment teams, etc. But then also we have quite a unique structure. We have investment committee for the portfolio that gives me this additional, devil's advocate challenge when I bring on new investments. And on this investment committee, we have people, very high caliber people in the industry. John Roberts, he's chair of Macquarie Infrastructure and Real Assets. Sally Box, she comes from Future Fund with real estate experience. And we have Adrian Su, who comes from a global private equity firm, Carlyle, so very much private equity experience. And Jeff is the chair of the SC.
No, thanks, Tanya. And obviously, as I'm on the board, I've seen the great work you've done, and since you took over, there was virtually nothing in the profit reserve, or a couple of cents, and you've been able to grow it to 16.8 cents. So in terms of the dividend, it's gone for, it's sort of 4 cents, and then, I'd assume it'll be interesting to see what the board decides, but it'll be gently increasing. So in terms of, so I know your abilities, but it's harder for the shareholders to understand. Do you want to give a little bit of your background in terms of,
my experience?
Yeah, your experience. Because to me, you're incredibly well experienced to do this, but just so the shareholders understand that.
Yes, that would also explain why I'm really passionate and excited about this portfolio. So over my career, just over 20 years, I've been working across asset classes like real estate, infrastructure, private equity, in various markets, so not only in Australia, but in the UK, the US, and then Australia. And I've been investing on behalf of large institutional investors. So, some of the names like Aware Super, they were the clients for whom I've been building out their private markets sleeves of the portfolios. And over time, I did see that institutional investors, they've been actively allocating or investing in alternative asset classes. In fact, you look at most of their portfolios, 30% plus would be invested in those asset classes. Looking at the broader market and our retail investors in Australia, that exposure has been minimal. And I really see our portfolio as a great opportunity, a great access point to those asset classes for our shareholders. There is no reason why not to invest in those asset classes. In particular, hearing my colleagues, what's happening in the broader markets, volatility, uncertainty, inflation, rising interest rates, alternative asset classes, they do provide very strong diversification benefits. So Some of them, like water rights, they're actually negatively correlated to listed equities or other asset classes. Most of them would have inflation hedge, embedded inflation hedge. So one of the exposures within the portfolio is Wollongong day surgery, just as an example to give you a flavor. And it's an asset that is leased for 20 years to a tenant, high quality tenant. And the leases are CPI-linked increases every year. So, if I look at the exposure within healthcare real estate in WMA portfolio, 70% of the income is linked to CPI, and that's across other asset classes. So that's inflation hedge. Interest rates, asset classes like private debt, provides a really good opportunity to protect from rising interest rates because most of their deals, they have variable rate. So it's actually a good environment when the interest rates are rising. In other words, looking at this not only from the pure investment return perspective, but also what does it add to an overall investment portfolio, those downside protection, diversification, and other benefits.
Gotcha. And one of the great things I know from our perspective is that you're talking about water rights, and you had been dealing with all the people that was in the portfolio
Yes.
when we took it over.
Yes.
So you already had the networks, the contacts.
Absolutely.
You had been doing research on them for a long time. So,
Yes, and that's the key because those investments, they're not listed investments, so having access to the opportunities through the network is really important.
And just looking at the alternate asset portfolio over the next 12 months, what's sort of what's your outlook or your view? Or?
I'm not as bearish as you.
Well, no, I'm equities.
I'm not as bearish, yes.
Yeah.
So
I'm equities, so we feel the pain and then we come back up.
Yeah.
We do it over the long term, but you guys sort of go more gently.
Yes, absolutely. So
I'm only short-term bearish. I just want a good bear market to get some great opportunities.
Yes,
and then we have a bull
I have
market
a
on
very
the other side.
Yeah, different stand.
Yes.
So for the next 12 months, when we look at the current portfolio, about 60% of the portfolio has been maturing over time. Maturing, what it means is that the investment was made in 2015, 16, 17. Over that period of time, the strategy has been implemented. So now it's the time to either sell those assets or exit those businesses, which means as a portfolio manager, I'm now realizing the value of those assets. The exits that we've had so far have been all over carrying value of the investment. So my expectation is that we'll see more strong exits to come over the next 12 months. And in terms of reinvesting this capital, this current time is a really good time for alternative investing, really across asset classes. The key is quality and following those thematic trends and thematic investing. So this is what I'm working on for the next 12 months in terms of identifying those opportunities and reinvesting the capital.
Perfect. Look, thank you, Dania. Thank you very much. And if anyone has any particular questions for Dania,
I'll be outside.
Should be outside. No, thank you for your
Jeff.
hard work. Thank you. Okay, so look, we just thought we'd give you a taste of WMA. In terms of, I know, Dania, everyone thinks I'm very bearish, but we know there's, what we've learned by Katrina giving me those facts, it's really the time in the market, not the timing of the market. And I think Oscar mentioned as investors, the tough thing about investors, you've got to work against your emotions. If you can turn your emotions off, it's great from an investing perspective. It's not great for a relationship perspective. So you've got to be buying, sort of when there's a bit of blood in the street. I don't think there's enough blood there in terms of the exceptional value. And we know the great thing is there's enough grey hair or no hair in the audience that we know that after bear markets we have bull markets, and the question is, just to me, it's how quickly you make your money back. And I know WAM Capital, the last during the GFC, I think it was it took the market 6 years to get back to its previous peak, and I think we made the money back in a couple of years. And the good thing is we've got a really, you saw just a glimpse of the team. There's 15 really smart people that are very passionate about managing that money. So what I'd like to do now, now we've got the Future Generation segment, and I'd like to invite Carolyn Gurney, who's the CEO of Future Gen, does an exceptional job. I will walk off that way and she'll walk up this way and take you through the next part of the presentation. So thank you very much, Carolyn.
So you're actually going to see Jeff again in about 3/4 of an hour, because we're going to do a panel with the Australian Financial Review. I'm going to change it up a bit and sit here. But I'd really like to welcome on stage as well Lex from Youth Off the Streets and June Bay from Tribeca, and Martin McCarthy, who's just coming up, who is basically on the investment committee for FGX and FGG. So now Jeff has gone out of the room, I'm going to talk about him. So basically, we haven't been on tour. We haven't spoken about Future Generation for a number of years, really, to an audience. So it's exciting, really exciting to be in front of you all. So Jeff, in 2012, he went to London and he read an article in the Financial Times, and it basically talked about a group of fund managers that had come together to work for free to make a social impact. And so he sort of mulled over this article and thought, actually, we all do a little bit for charity. We all do a little bit, but do we do enough? And how can I utilize my investment skill, my networks, our shareholders to actually make more of a difference? So how do I leverage the financial markets? What do I do? So he came back and he spoke to a number of other fund managers. So you had Gabriel from Sandon, you had David Paradise from Paradise, and a number of others. And so Future Generation Australia was born. And that was about investing in Australian equities. So he brought the fund managers together. He also got a number of the providers to actually help underwrite all the costs. And then he went out to shareholders and said, we all want to make an impact. How can we do that? And so what they came up with is that you would invest in this company, and you would get no performance fees, no management fees. All the fund managers would work for free, but we would give 1% of the total to make a social impact, to give that to charities. And it was really successful. It kind of resonated with the fact that I can put my money in, I get a dividend, and I can look after myself, with that, but also I'm going to be giving that little bit to charity. And so I think from him and from me, without a doubt, and I have been CEO for 6 months, it's about getting everybody to have a little bit of Future Generation in their portfolio. So we give back. Then 2 years later, he wanted to do the same again with global equities. So Future Generation Global was born. And when I think about sort of the global side, I think, we had to bring in a different range of managers working for free, no performance fees, no management fees, and we give that 1% as well. But we took charities that were very, very different. So for example, for Future Generation Australia, it was youth at risk. And the fact that Lex is here today, is testament in terms of what she's going to talk about, in terms of the impact that you've all made as shareholders to her not-for-profit. And then with Future Generation Global, it was about youth mental health. And that's something I think during COVID we've all seen, we've all experienced in some way. So I'm really pleased that I can talk about those today. So we have a slide in some of the fund managers and the charities we support. So luckily for you, I'm not going to go through every single charity and let you know what they are. But I think the best thing really would be to ask June Bay to talk about, what does she do as a fund manager? You work pro bono, the money's in your main fund, it's important. I feel it's really important to you. And maybe if you can talk a little bit about your inspiration and what your outlook is as well.
Well, absolutely. So, look, my inspiration, first of all, I'm very honored to be here. Thank you so much for including me. And it's always a pleasure to be talking to everyone here. For me, it's an honor really to be able to manage money for future generations. And it's such an honor really to be part of the Future Generations family. Not normally when when we're in the finance industry, exactly like what Caroline said, that we do a little bit of charity things here and there, but we never really follow through, and we never really follow up to see what happened, and all have a strategic vision of where we want to get to. We just feel like we want to do more, when the opportunity came up, I think we probably been managing Future Generations money for 7 years, since 2015. I just checked, and almost since the beginning, and that was just really eye-opening for us. Every day we get to do the things we're passionate about, which is investing in the share market, buy, sell shares. At the same time, we're doing something that goes towards all the social contribution. And also what's amazing is that, normally we don't hear about all these different sort of charity. We hear bits and pieces on TV advertising and things, and they tend to be the similar really large charities. What Future Generation does is bring this portfolio of charity and show us what they do. And it's just been incredible to, along this journey over the last many years, to get to learn those charity. In fact, I have become very close to some of the charities. Today we'll hear from Lex about her charity, and I've become very close with Ray's Foundation. Also another little one, they help high school kids finding mentors during a time when it's been very challenging. So it's just incredibly rewarding, and then by doing something that I love at the same time. So inspiration is fantastic.
Excellent. So tell us a little bit about your market outlook. I mean, obviously you've heard from WAM this morning, but in terms of your outlook, what is it? Because I think you have a slightly different perspective.
Oh, look, absolutely. Well, first of all, I think I'm speaking from an active investor. What does that mean? So my fund actually does long short, which means we can buy the companies, invest in companies we think share price will go up, and then we can short the companies so we think the share price will go down. So that give us a lot of incredible amount of opportunity in the current market where it's sort of gyrating. But ultimately to us, market is a lot of investors in the market is very short term, focusing on what's happening in the next month, next 3 months. Now, things does look a little bit tough in the next 3 months, as you probably heard from Jeff in previous sessions. Things will slow a little bit. But remember, we have gone through a tremendous amount of growth in the last couple of years because of stimulus. So yes, we will slow a little bit. There's a little bit of inflation. We do have to manage through that. But remember, a lot of inflation is to do with border closure. We don't have labor, couldn't move around. So a lot of that will come off. A lot of those things will slow to come down. And the share market has come off a little bit. A lot of those bad news has been priced in. So as an investor that focuses on long term, this is an amazing opportunity for us to buy the company that's been sold off. So our market outlook is actually reasonably positive. We think the Australian share market looks pretty good. We're not particularly expensive. We have a lot of commodity focused businesses. We have banks. All of these companies will pay a huge amount of dividends over the next 12 to 18 months. China is going to stimulate. So all of that means, Australian market looks pretty positive. Probably not going to give you the double-digit return that we've gotten used to see in the last few years. But still, regardless, it's positive. And the dividend yield we're looking at the market is about 5%. And that's not too bad, fully franked. So all of that together will support our economy. Our inflation is still not running away. So, I think the market still look pretty reasonable.
Excellent. So one of the things we ask all of our fund managers to do is to give 2 stock picks. For you, slightly different to the WAM ones. Yes, I think they are. So I'm just going to ask you to give your 2 stock picks, and why now, and for the long term.
Yeah, absolutely. So I must say, when you say 2, I was thinking, I got so many because the market is volatile.
That's for next time.
That's next time. Market is volatile and it presents opportunity in some of the highest quality companies. Remember, this is a market condition. Any share market, you always have to stick with quality companies that have proper earnings. So the number 1 is a very favorite name is CSL. You know, this company has been the most successful, one of the most successful Australian story, listed in 1990 from a government institution, moving to probably the top 5 company in the ASX and a global company. Incredible success story, double-digit growth for decades with double-digit to come. So this company is a truly market leader. Now, what's been happening in the current environment is that all the investors become nervous about growth companies, tech companies in particular, because interest rates are going higher. So when investors tend to have tunnel vision, once you start investing in share market a little bit, they will have tunnel vision. When they think about tech company, they go, okay, that's expensive, sell that. What else is growing? So anything that's growing has been sold off. So that's including CSL. Clearly, it's going quite well. So that's been sold off. For CSL, I think in January, fell something like 20% to 25% in 1 month. And that is so unusual, just because investors sort of just so scared about something and then all piled into, obviously, the likes of BHP. And that represents a lot of opportunity. We think this is a great buy. Regardless what's going to happen to the economic outlook, whether US is going to slow down or globally slow down, this company will grow double-digit for the next many years. And that's regardless of whether there's a recession, non-recession, very defensive. And the company is cheaper than how it's ever been. So, we think this is a fantastic company and it's a great time to be buying now. And it's almost like a bottom drawer sort of company. So that's the first one.
Let's go for the second one before I ask you some questions on it.
Okay, let's go for the second one. So again, the second one, we tend to be a little bit contrarian. So we pick things that's sort of being sold off and nobody likes at this point. I'm going to pick a tech company, which you probably know which one, Xero. Again, it's a market leader. It's a leader in SME software, focused particularly in accounting software. However, it's recently branching out into some of the HR and other space. It's got a great platform. It's got decade-long execution, a sort of proven execution in dominating market share, in dislodging existing incumbents. It dominated market share in the New Zealand first, a little New Zealand company, and then it came to Australia and then replicated its business model and then dominate the Australian market. And then it went to the UK a few years ago. Again, they replicated its business and dominated that market share. And now they're gradually moving inroad into the US as well. So to me, this is a business, again, it's a bottom drawer business. It's a business that in 5 years will be significantly larger than what it is today. People worry about, today's earnings really expensive and all that. But this company not buying today's earnings because they just showed you that they can replicate their business model in New Zealand, in Australia, in UK, and US. It could be global dominance. Remember when CSL was a tiny company? Remember when Cochlear was a tiny company? There was so much skepticism. Remember, how expensive people used to say those companies? It's the same thing. So this is another company. I think it's great to buy. Share price volatility because people worry about the short term and it's expensive and all that. You know what? Share prices come off more than 50%. It is the time to be buying this.
So you actually spoke before about that. You've got lots and lots of stock picks that you would recommend. So are you moving your portfolio around a lot of the time? Especially with what's been happening in markets.
Look, what we do with our portfolio is that we become opportunistic. So simply because the market is actually quite volatile and there's not enough investors in the market to keep the price consistent. That's why you can see the big price drop, like CSL, top 5 company to drop 20% in a month. It's unheard of. So that presents really nice short-term opportunities. When it does that, we will jump in and buy these companies. And then when we make our return, we'll trim or we'll find other opportunities. And being the active investor, the long short, it allows us to do so because we never run out of money. So we can always find short opportunities to continue to buy those opportunities as they advance.
Excellent. So we can ask Junbei questions afterwards, but I just wouldn't mind going back to my sort of stock pick, which is obviously Future Generation Australia and Future Generation Global. And when you talk about diversification, I mean, that really rings true to me because that's what we've actually tried to do with both of the companies. And Marty obviously is on the IC and is sort of responsible with, we have fantastic IC committee, which has got Zenith, Morningstar, well, the founder of Zenith, I should say, Morningstar, Jana, a number of fund managers as well. And they look at the composition of both of the portfolios. And I mean, Marty, it might be worth just saying a few words on how we balance all that together.
Yeah, no worries. And look, I think when you look at the FGX and FGG proposition, I think we described it earlier when we were talking about it. It's almost a win-win-win proposition. For the fund managers, they're able to give back to the community without us asking for a cash donation. It's not extra work for you. You're managing a portfolio already. You're just giving us your expertise and your time and capacity in your portfolio. For the charity partners that we have, it's an annuity and a consistent stream of income for them to be able to do the great work that we're doing, and I'm really excited to hear from Lex and the work that you guys are doing. But from a shareholder perspective, it's much more than that. What you're getting is you're getting access through a listed investment company structure, access to a diverse portfolio of investment managers and a portfolio of managers that have been handpicked by an experienced investment committee, as Carolyn touched on. And what they're looking to do is blend complementary managers together. So we kind of categorize our managers into 3 key categories, being long equities, absolute bias managers, where Junbei would sit, and market neutral managers in the case of FGX. And what we're looking to do from a shareholder base is provide you with consistent performance and take away some of that volatility in the market. So it's a really exciting opportunity economically from a shareholder perspective. If you wanted to replicate this portfolio yourself, you'd be paying a management fee largely in excess of 1%. You'd have a performance fee. You'd also have the additional costs involved around running a listed investment company, board fees, investment committee fees, and service provider fees. Everybody's working on a pro bono basis here. So for you're getting that access at no cost, and 1% is going to philanthropic organizations in lieu of an investment manager.
I think it's really important for us, nobody really wants to invest unless you get a return. I think that's incredibly important for everyone. So you get, maybe we could show sort of the dividends for you. So what Marty talked about is basically we have 2 companies that are actually, they have growing sort of dividends. So that's really important. That's the feedback that we've got from a number of shareholders. So it's basically, say for example, Future Generation Global, it went up by 200% last year, and it's gone to twice yearly to 6 cents per share. And we have a fantastic profits reserve, which Jesse Hamilton, the CFO, has been working on. And we have 8.1 years coverage. So you actually make sure that you get that long-term, understanding that's going to be there for the long term. And then with also Future Generation Australia, we've got basically a profits reserve there of 4.8 years, and also the dividends are going up. That's 6 cents. So for me, the fact that we've got a dividend yield and the growing dividends makes a huge difference. But what is really important also is that sort of social impact and the business of social impact. I think it really is a business, and the fact that we can actually give a number of not-for-profits money over the long term, so they can actually plan, so they can actually do what they're really good at, I think is really what our mission is as well. So I'm delighted that we've got Lex here. Your not-for-profit Youth on the Streets has been around for a number of years. It helps so many young people, and I think for me, you've always been very much the fabric of what we actually do, especially in New South Wales. So I'd really like to ask you, what is your inspiration? What gets you up, to go in, because it's a really tough area, youth homelessness.
Yeah, thank you, Caroline. Thank you for having me here. I've not been to something like this before. This is all very new to me. So
It's quite daunting.
It's not so much daunting. It's just like it's struggling to keep up with some of the terminology. So I'll try and be mindful of that when I'm talking about, I guess, youth homelessness terminology as well. So what gets me up in the morning? Look, I never knew what I wanted to do when I was at school. I wasn't concerned about that. I just didn't have an idea of what I wanted. And I started year 11, I became unwell, I had to leave, and I went back and decided I wanted to finish my HSC because I'd started it. And I still didn't know what I wanted to do. I ended up doing different jobs in Sydney. I worked at Randwick Racetrack as a strapper. I worked as a car detailer in a smash repairs. I was a courier. And then I finally went to university. I thought, I want to go to university and then see what it is I want to do with my life. And I did a social science degree with a double major in criminology and psychology. And it was while I was there that we got to the psychometric testing component of the psychology part of it. And I thought I need to go through a practical example of doing that testing. So I applied for a job that had that as a component and did the testing, which was very arduous, and then got a call back. And I thought I need to look at what this job is. And it ended up, it was working with young people in custody at Yasma in Sydney, a girls' jail. And I thought, I don't know how I'm going to go with this. Like, young teenage criminals, like, is this what I want? But I went there. I stayed for 10 years. I loved absolutely every moment of it. My frustration was that we were not able to reach the young people early enough before they ended up in custody, and we just seemed to be preparing a lot of young people for an adult jail, which seemed to be, it didn't satisfy me. So I looked at the not-for-profit space, and I worked in a few different organisations and came to Youth Off the Streets 10 years ago. So I guess the thing that gets me out of bed is that we have a huge homelessness issue in this country. We're very good at working out what happens overseas, but we're not very good at looking at our own backyard. And, you know, tonight just in New South Wales, there's 10,000 young people who are homeless. When Father Riley started Youth Off the Streets in 1991, there were 10,000 young people homeless in Australia. So we're not solving the issue. It's actually, you know, becoming an increasing concern. So for me, I feel that I had opportunity when I was growing up. I didn't experience, you know, a lot of hardships that our young people do. I had a good home life, and I think that it's a right that young people should be able to be given opportunity to be able to make their own decisions and not have circumstances forced on them at a young age and then not be able to ever recover from that. You know, we're talking about the cost of living and interest rates going up and how incredibly hard it is to get into the property market. It's like, well, you need to also consider there's a big chunk of young people in this country that that's never going to be an issue, like having a property and even having job security is going to be problematic as well. I know we're very excited that we got down to 3.9, I think it is, % unemployment, and that seemed to be a big issue for the election. It was more about a percentage rather than the people impacted, and yeah. So I just think that getting me out of bed is that we've got a big problem we haven't solved. So
what do you do? What do you do on a day-to-day basis? I mean, for me, I look through COVID. I mean, I see my daughter. You know, she's had friends staying on her floor, you know, and I think that whole couch surfing piece whereby, you know, a lot of students, you know, the hope in a way for our future, a lot of students at university, you know, they used to stay on each other's floors when they didn't have anywhere to go and they could balance it, but they don't actually have those relationships now because of COVID. So from my point of view, just with that, you know, the hope in a way, you know, they're at huge risk of being homeless as well now.
Well, that's the thing. There's an added layer, I guess, with COVID. We had young people that we normally wouldn't have contact us, and they called to say, look, I lost my job, I can't pay my rent. I'm not sure if you're a service that can help me because I've never been in this situation before, but what do I do? So that was very early on at the beginning of the pandemic. And there's still a problem for, the thing that I don't understand is that nobody can fill positions. Everyone's got vacancies in their employment. We've got 22 vacancies in our organisation at the moment, and we're really struggling to fill them. I don't know where everyone is because there's also a lot of people that can't get work. So that's a problem, you know, moving forward for us. But yeah, there's more young people that need support now, and they're not young people that have just been disadvantaged from very early childhood. They're young people that are becoming disadvantaged now because of the pandemic and because of the cost of living. And that means that we're an organisation that we get 50% government funding, so 50% of our income we rely on future generations, corporate partners, grants, individual giving, and that's really unstable as well, particularly when you have a pandemic and people give to a charity. When you're looking at reassessing where you're giving money, one of the first things you're probably going to look at is, well, can I afford to do that? So that was a big impact for us as well. So there's more of a need in this space, and there's less, I guess, money around to support that need.
And what have you been doing with the future generation money?
Well, we've been primarily using it in our Aboriginal services part of the business, and we've been since 2016 when we first started receiving support. We've been providing cultural camps for young people, getting them connected to community, providing intensive case management support for them, helping them with housing, mental health, those types of things. And more recently, last year, it was when the pandemic hit Dubbo area. There was a lot of, there was an outbreak there, and we were sort of stuck in isolation going, we must be able to provide some support to this regional community. So I spoke to some of my staff who actually were born in that area, and we contacted the Health Minister and the Secretary of Health and Police Commissioner, and we were able to take, we have a semi-trailer that opens up. It's like a big transformer, and it's a mobile classroom essentially. And that went out to Wilcannia and was used for 3 months by New South Wales Police as their command hub, because there's not a lot of infrastructure out there. And we sent our cultural team across to Dubbo, and they provided support to around 3,500 young people and families in that area, because everything shut down. Like, people were taking the stay at home seriously, but there was still a need to support people in that area that were not getting access to the support that they needed. So there was food support and help with vaccinations and mental health support, and also to the broader areas around Wellington and Wilcannia and the other communities. So that was more because we had to adjust. I guess the thing with when COVID hit, the good news for us was that one of the first organisations that contacted us was FGX and said, look, we understand that you're probably going to have to modify what you're doing, what you're delivering at the moment because of the isolation restrictions. You know, let us know what it is how you need to adjust, and we're happy to continue supporting you. So that was a relief for us at that point, because it was very much an unknown of how we would be impacted. I think it was, I was listening to something early on with COVID, and they were talking about how they expect, because of what happened with Qantas, and, you know, so many people lost their jobs basically overnight. And they were saying if charities think that they're going to be immune to that, they've got rocks in their heads. So for us, it was just a matter of staying afloat to get us to this point, and hopefully to work out how we can keep moving with COVID and beyond.
So Future Generation across both companies has given 52.9 million since inception, and we're on track this year to probably around 13 million between the two companies to give to all these sort of amazing not-for-profits. With Future Generation Global, we've actually changed. We've just done an expressions of interest, and we're actually moving towards the prevention in the mental health field, so that we can actually help young people before they need intervention or treatment. And that's something our social impact manager is working really hard on. We had 175 applications, so we're working through those at the moment, because we all believe that young people are great. They have a fantastic future, and if we can put support there to help them, we can try and ensure that. But one thing I wanted to ask you, Lex, and if there are any questions, if you put your hand up, we'll come to those in a minute. But like, everywhere closed during COVID, but you couldn't. So how did you manage that?
Well, yeah, that was the interesting thing, wasn't it? It's like, isolation, stay at home, don't go anywhere. And we work with homeless young people who don't have a home. So, that was difficult. Our refuges, they operate 24/7. So our concern, I guess, was if we had an outbreak, how do we manage that? And also, how do you keep young people that you've just started to provide support to in a refuge and say, you can't leave, you must stay here? That was initially a little bit tricky, but as young people started to see people dying around the world, they became the enforcers of the rules in the houses, which was good. Our schools, we have 6 independent schools. They went to remote learning, and that was also an area we're not quite sure how that was going to work, because we work with disadvantaged or disengaged young people from education in the first place. They're disengaged from mainstream, which is why they're with our independent schools, so they need more support. But they kept working online, and actually when we came out of the pandemic, the lockdown, they were keen to actually get out of home and get back into the classroom. So that was a relief as well. But it has been tricky. Our bigger events we were not able to run. We still had to work out how we could provide that individualised intensive support to young people without it being face-to-face. So there was a lot of Zooms, a lot of phone calls, and a lot of adjustments. And at the same time, you're dealing with the concerns that staff have as well when you're saying you've got to go to work, you've got to go to the refuge. And it's like, but, what about COVID and what about isolation? So that was a tricky area to navigate as well.
We're really passionate about what we do, so if you have any questions, all of us can talk about it afterwards. But please come back, grab a lunchbox, come back in and listen to Jeff and Phil King from Regal, and as well as June Bay as well. And thank you very much.